taking an unconventional look at stocks, property, bonds, economics, and more. This is the Total Money Management Podcast with Steve Moriarty, Tom Hill, and Jacob Senior.
All right, welcome back to another episode of Total Money Management. I've got Steve Moriarty with me here today. How are we doing, Steve?
Good, mate.
No Jacob?
No Jacob. He's on a boat somewhere. We don't know where. It's a mystery.
He'll be back soon.
It's a mystery. He's a man of mystery. He was on a private jet. Now he's on a big boat somewhere.
Must be very nice.
Tough life if you see what happens when you don't have kids.
Yeah. Well, look.
Anyway.
Look, what we're going to be covering off today, the week that was March 11 to 15, the theme of this one really is about the market's really expensive and it's going up.
Beautiful.
All right, it's obviously a lot of fun. I know you wanted to kind of kick off, Steve, with talking about why you should manage your own money, avoid individual stocks and don't buy and hold.
Yeah, there was a really good article which we put in the document, the subscriber document, which is most stocks are bad for your wealth. And it's a point that we talk about in the risk hierarchy, right, which is that for years we've been obsessed, we being people generally, and money managers always talk about buying the best stocks, right, the best companies. Let's do a Warren Buffett, let's do a growth investor. And what I like to do is just look at the probabilities from an average person's point of view, right? Because what people are doing is when they're giving their money to a fund manager who says, this is the way the stock market works. You've got to pick stocks. You've got to hold a portfolio of them, the best stocks and blah, blah, blah. What I want to say is, okay, what are my odds of that this guy, Steve Moriarty, is going to outperform the market? When you look at the odds, it's basically a no-brainer to not give your money to fund managers, right? Because their performance is awful.
Well, I really like that Nassim Taleb example that you gave before, if you can kind of reiterate that one.
Well, Taleb said it. It's also Warren Buffett said it, but in a different way. But what you think about randomness, right? Now, randomness says there's no pattern, okay? So you get 10,000 fund managers in a room and you say to them, it's a big room, and what you do is you say to them, righto, whoever loses, right, whoever doesn't beat the market, you're out, right? So pure randomness is 50-50, right? So let's say 10,000 becomes 5,000 after 1 year, right? And then the next year, the 5,000 becomes 2,500, 1,250, 600, right? You get down to about, I think it's 217 or something. But my point being, after 5 years, just through sheer randomness, you have a cohort of operators that have beaten the market purely by luck, right? They had a really great 5 years. And what Buffett said is, and Taleb, they'll now start telling you how to beat the market. Right, and what you see this all the time. Every decade they have the fund manager of the decade. They never go on to win it twice, right? Because what you find is the market mean reverts for a start, but the important point is that it's a little bit like every dog has its day, right? And what we do is confuse that dog for skill, rather than saying, well, someone had to beat the market and it ended up being these 200 people. So the corollary of that is that when you look at the statistics of who beat the market, how hard is it to beat the market, all of that stuff, by picking individual stocks, there's like one Warren Buffett and, 10,000 fund managers who don't beat the market. And so the point of the document here, this one, which makes it really interesting, we know that there's something like 85% of fund managers don't beat the market. Okay, so that's the first point, right? So there you're saying, oh, Jesus, what's my chances of picking a fund manager?
Yeah,
right?
15%.
That outperforms over time.
Almost better off picking an individual stock.
Well, basically yourself. But the argument then extends to say, okay, well, how many, what's the balance of stocks? Let's ignore fund managers, right? We know they don't beat the market. Okay.
Yep.
How many stocks beat the market? And what you see is it's tiny. There's been studies that show that it's like there's a handful of stocks, and by a handful I mean 10 or 15, that have been responsible for most of the market returns, right?
Yeah, well, like in that article that you shared with us earlier in the week that went out to the subscribers, you posted a chart that says from 1996 to 2017, 73% of individual stocks failed to beat cash. Not the market.
Cash. Yeah. So it's the same at the moment, right? Everything's been driven by the Magnificent Seven. It's sucking up the other 493. It's dragging them up with them, and it's making the index look really good. And so that equivalent, what you're doing is sort of saying these 7 stocks are going to outperform forever. Well, clearly that's not going to happen, right? And then you take the next step and say, well, when you look at those statistics, the chances of you beating the market are really tiny with picking individual stocks. Now, like we do it, we talk about asset allocation and rebalancing indexes or using ETFs. That's different. Now, people will go, oh, yeah, of course it is. But it is different because what we're doing is using an ETF for a start. ETFs, country indexes or sectors or styles, value versus growth, they generally don't go bankrupt.
Well, you're getting access to realistically hundreds of companies.
Yes, yeah. So if 10 go bankrupt, it's like, well, who cares? There's 290 that are performing all right. Okay, and that's the idea of the index. You won't get Nvidia's 1,000% in 1 year, but nor will you get the 10% of companies that went bankrupt, right? So you get somewhere in between, and that's a really important point because when fund managers outperform, you have to ask, is it a Warren Buffett type outperformance based on 60 years of investing? There's a solid foundation of research that says value investing works, or is it simply this guy bought the Magnificent Seven 5 years ago? Okay, fantastic. But I'll bet he didn't think he was going to be up, 450%. Now, he probably will say, oh, yes, I did. That's why I bought him. But that's bullshit. The reality is that you get those lucky streaks all the time, right? There were lots of people in The Big Short, right, who picked the mortgage-backed securities issue. But after that, they went on to make statements, and I think we talked about this a few weeks ago. Michael Burry, John Paulson, Burry said water was the next big thing. John Paulson said gold, right? And they didn't go on, and they lost plenty of money, right? And that's my point. If you get them for the ride up, fantastic. But, please don't think they're going to outperform like Warren Buffett's done over 50 years. And even Warren Buffett's had periods of underperformance. So it's really difficult to pick stocks that beat the whole market, right? That's the sort of point of that one.
Yeah, right.
And just to let you know, Australia is something like 75%, right, which is about the same. So 75% of stocks fail to beat cash, right? Not even the other market. They fail to beat cash. I mean, that's miserable. But
really, it probably would have said, that time period, 1996 or whatever, up to 2024, if we didn't have that period of super low interest rates where cash wasn't making you anything.
Well, that may well be the point, right? That interest rates were falling. But remember in 96, right, interest rates, if I remember, they were about 9%. So, Tom, 15, 20 years ago, interest rates were about 6%. We were saying they were cheap then. Then they went to 5, then they went to 4, 3, 2, and then they went negative, right, during COVID. And people going, oh, it's insanely cheap. And it's like, well, yeah, but we thought it was cheap at 6. Do you see what I mean? Like the subjectivity is, well, when is it cheap? Well, it's cheap when it's below the long-term average and long-term average is about 5. Okay, so 2 and 1 you can say is really cheap. But then we also know mean reversion kicks in, and here we are. We're now back at, 5.5%.
Yeah, and it only stings because the asset prices are so bloody high at the moment.
Yeah, absolutely.
The other thing that kind of happened this week, Bitcoin hit almost 74,000 USD.
Bing!
Now, I know that you don't love Bitcoin, and that's fine. We're not, obsessed with it either. But I think it's just worth pointing out, right, because now that it's made an all-time high, what am I starting to see? We were just at the coffee shop then, and we could hear the people next to us talking about cryptocurrency. I was on LinkedIn last night.
Right.
And, you're getting posts and Facebook, people starting to come out of the woodworks going, please, if you do anything, just buy some Bitcoin and store it, right? I just think, look, I don't...
Why would you buy something that's just gone absolutely gangbusters nuts?
Yeah. Look, as we were discussing earlier, we all love a story and a narrative.
Yep.
The Bitcoin halving's coming up. So for those that don't know that, basically it means the reward that miners get for mining Bitcoin gets cut in half, right? So it becomes harder to obtain.
What, the higher it goes up?
No, so without going into how mining works,
Yeah.
Every amount of blocks that are mined, the reward will get split into. So now, in about a month's time, miners will earn half as much Bitcoin as they do today for the amount of work that they put in.
Right, okay. So it's like being paid $10 an hour, now you're getting $5 an hour.
Yeah.
Right.
So the theory is that's going to increase the value because it's going to be harder to get, right? That's the thing.
Right.
And so, there's this whole theory around a market cycle that kind of centers around this halving.
Right.
And it's usually expected that it's going to go up a lot. Now, we're sitting at all-time highs now, and I think it's dangerous to be encouraging people to buy at this price. It may very well go up another 2-3 times. I don't know. I don't care. But I was talking to someone the other day, and look, I think it's just worth touching on because at some point you kind of got to use a bit of common sense with this stuff. If you bought now and it doubles, great. On paper, looks like you made a lot of money, but unrealized profit is not profit.
Yeah.
It's only profit if you sell some. And when are you going to do that? Because the next thing, if it does double, people are going to start talking about how it's going to go to 500,000 or $1 million, and that's going to become
those stories are back. It's going to be $1 million or something.
100%.
But you see this this is why I say, if you've got experience long-term in the markets, this is not unusual. Bitcoin is simply the asset class, if I can use that terminology. Bitcoin is simply the investment vehicle that is the speculative, is the vehicle for people to speculate in, right? And you see this, and Robert Shiller talks about it all the time, about this AI is now the same thing, right? And, it was lithium, and then it was, something before that. In 2000, it was the internet. In 1960, it was the Nifty 50 companies, right? And so, 300 years ago, it was tulips. These are merely bubbles. Whether they survive or not, like you can still buy tulips, but they're a hell of a lot cheaper than what they were, right? So, will Bitcoin last? Well, it could, but when you look at the history of the bubbles, you get to understand that it's probably more of a bubble than it is a fundamental investment. Now, you were talking before about BlackRock, has now got a Bitcoin ETF. And so when you go back, this thing's gone so far now that the arguments about anti-libertarianism, libertarianism, fiat currencies are rot and, you've got to buy Bitcoin because governments are going to inflate everything away, blah, blah, blah. That argument's now out the window because we've now got Bitcoin ETFs run by 55-year-old white guys in New York. Right, so you look at that and go, mate, you can't get more mainstream in finance than 50-year-old blokes in New York who own, lots of money. So my point is that what's happened now is, and this is what goes on, first of all, there's a bunch of outsiders who say this, Bitcoin, crypto, whatever, is going to go to the moon and it's the new way, right? And 85% of us go, listen, that's garbage. ignore it. Then it starts going up in price and you get Bitcoin millionaires. Oh, well, that's pretty interesting. Then you start sucking in more people to go, I might have a look at this stuff. So it creates a momentum of its own. Jamie Dimon came out, I think, 2 years ago or something and said, Bitcoin's crap, blah, blah, blah. now they're in a Bitcoin ETF, right? And so my point being, the finance industry, right, are just like leeches that say, how can we make a profit out of this? They work out how to do it, and then they tell everybody to go and do it, right? So you should go and have a Bitcoin, ETF, blah, 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 buy our Bitcoin. Why? Because that's where they're generating fees. It's not about whether they don't care in terms of, we deeply believe that Bitcoin's going to change the world, right? I could bet you $1 million, you look at all those guys' portfolios, hardly any of them would own Bitcoin. If they did, they're doing it knowing that they're going to sell really quickly, buy and sell, because they know that it's not an actual serious currency, right? Governments are talking about regulating it more, all of that sort of stuff. So from that point of view, you can buy it and sell it, but the idea of you can buy it and hold it forever and it'll be worth $1 million is ridiculous, because no one knows what it's worth. What you're seeing on the screen is a price, but you can't tell me it's worth $10 or it's worth 10,000. Now, or 50,000, right? It may be worth 100,000, but
how do you value it?
How do you value it?
Yeah.
Well, you can't, because there's nothing to value it against. Right,
Yeah.
that's the point of it, Tom.
100%. Yeah, look, this isn't a pro or an anti-Bitcoin podcast. I just think it's worth bringing up because,
yeah, absolutely.
If you look at market cycles and how they work, usually when something goes on a big run like it's happening now, everyone starts to talk about it.
Yep.
People start to get a bit of FOMO and they think, oh, I really have to get in. I have to get in. And when you get emotional with it, people have a tendency to overexpose themselves. So I think if anyone wants to dabble, that's on them. But really just think about asset allocation, whatever you're prepared to lose, right?
Yeah, absolutely.
So,
and it's always the tricky part, because, again, there was mumbles about Bitcoin, but now that it's risen, everybody's talking about it again. Mm-hmm. And that's where you get all sorts of stuff. I can't remember the name of the bias. Might be affirmation bias, but the more you read about it, the more it influences your position, right? And the more you might have a look at this Bitcoin. I mean, it's what's been going on in property markets. Everybody is talking about property, right? And you look at the news items and it's, these stories that connect, the Broncos beat these people. What does that mean for property markets? And it's like, oh, Jesus, please. But this is part of the setup with, key words, right? You got to talk about Bitcoin. Why? Because that'll get us more Google searches or, something like that. And to me, that's a really dangerous way to operate, because you're sort of, in my mind, you're just talking about stuff that's not actually relevant. But the more people who do it, the more it's going to go up the Google chain, the more the mainstream media is going to talk about it, right? And that's when you get FOMO and all that sort of stuff, where people are going, oh, well, hell, we should really start thinking about buying some Bitcoin, even if they know nothing about it, right? Because they just feel like they're missing out, because every day they wake up, someone's talking about Bitcoin.
Mm-hmm. Yeah. I think we should probably move on from Bitcoin, since I know that it's a touchy subject around here. On the Tuesday point, we kind of spoke about the fact that portfolios can go nowhere for a long time. Yeah. And at every one of the market peaks, the Cape was high, and right now it's really high. I know we talk about it a fair bit, but it's really interesting, right? Like, if we go and look at this from the period of 2001 to 2017 or 2011.
About 13, 14.
Yeah, 2004 rather.
Yeah.
Returns are flat. So if you hadn't taken any profit in the dot-com boom and, you'd watched your portfolio drop, took you 13 years just to break even again.
Yep.
Obviously, most people would have probably done better than that anyway, only because they would have been dollar cost averaging in through their super or something like that. But if you looked at your holdings at that point in time, you disregarded what you'd poured in after that point. It took you a long time to get back to baseline, right? Which is, again, why we kind of stress the importance of valuation.
Absolutely.
And rebalancing. Because if you looked at it at the time, went, look, Cape's really, really high. I'm going to take some of the money off the table.
Yep.
And then I'm going to look to pour a bit more in when it's cheap.
Yeah.
You would have done so much better.
It's a process about, and this is the difference. I'm going to talk about this in a few weeks on a masterclass, but this is the difference between property and stocks. Everyone talks about the difference in returns over 20 years or 30 years, right? That's, it's sort of relevant. But the point is this, with stocks, you can rebalance stocks. So if you bought, let's say you buy in 2000, right? And you don't know about this thing called the Cape ratio and the market's going gangbusters and you jump in, right? It's 35 at the moment. Well, it was 44 back then, right? So you jump in, right? You go, oh my God, I can't stand it. So you jump in, you lose 50% over the next 2.5 years, okay? In the interim, you run into Warren Buffett at a dinner and he says, oh, you should do this and you should do that. Or you read Robert Schiller's book or you go, holy Jesus, I've understood valuation. Now the valuation's more modest, I'll put some more money in, right? Or you start a rebalancing process. The difference with property is if you buy $1 million property at the top of the market and it falls 50% or say 20%, you can't rebalance that. Right, you can't say, look, I bought $1 million property. It's now worth $750,000, but it's okay. I'm going to, put more into it to reduce my $1 million price to $800,000. Well, you can't do that with property, right? You can do it with stocks. Now, I'm not saying stocks are better than property. All I'm saying is they have different characteristics, and it needs to be taken into account. So that's the difficulty with buying property when it's expensive, right? Because you're generally using leverage, not all the time, but most people are taking out a loan, right, of 20 to 25 to 30 years, and you can't rebalance that. Whereas at least with stocks, in 2000 at 44, the Cape gets to 2009 and it gets back to 13. If you put in more money there, you're bringing your average cost down. And as I said, you can, your returns are not going to be great, but they're going to be better than if you just sit there and don't do anything.
But if you'd taken some money off the table when it was overvalued and redeployed that when it was undervalued, you would have compounded it a way higher rate. If you'd just, added more in as you took some wages,
Yeah, well, that's the point about the importance of valuation, right, and liquidity and stuff. And again, I'm not, I'm not knocking property. All I'm saying is it's a different way of investing to stocks. And so a lot of it is, again, about liquidity, right? You can't sell part of a property, right? But also this important dynamic of saying the average return is not relevant to you. Right, and the reason why is because the average return is a compilation of 100 people who bought and sold property, and you average out. Tom made 20 grand, Steve lost 5, Jenny made 140, Bill made 32. Right, you add that together and go, right, the average is 16 grand. Okay, look, if you buy a property, the average is 16 grand. Well, it's not, because if you said, well, hang on a second, Bill lost 5 grand. What's the point in saying the average is 16, right? There is no average when you buy an individual property, right? Because it doesn't, the average is a collection of data points. It would be equivalent to saying, I'm going to buy 100 properties. I know 30 will go bankrupt or lose me money. I know 70 will make money. Okay, well, overall, I'll be fine. Well, you can't do that with property. Right, whereas you can do that with stocks by buying an index. Right, I'm going to buy 300 companies. Yeah, 10 will probably go bankrupt. Yeah, 100 probably won't do very good, but there'll be 150 that do really well, and generally overall, I'll be fine.
Yeah, and obviously you can't just wake up Monday morning, decide to sell your house, and then rebuy Wednesday.
Yeah, exactly. Exactly.
A better signal.
Yeah, so it's a really important point, because that's when starting valuation becomes really, really important, right? You want to buy, like stocks, you want to buy property when it's really cheap. Well, I think I put an entry in there on Wednesday or Thursday, I think. Thursday. You know, the property prices have gone absolutely gangbusters. There's no argument about that. The question is not, we know they've gone gangbusters. The question is, will they continue to go gangbusters from here? And if you're like a card player where you say, God, I've had a really good run, I've been really killing it, the question is, am I going to kill it from here on in? Now, in property and in stocks, we know that relates to valuation. And so it's not likely, when you look at the Sydney property prices that are like 10 times or 12 times income, when the average is about 4 or 5.
Well, it's gone, they've averaged what?
7%, I think, for about the last decade.
Yeah, well, it's gone up 97% over the last 10 years, and it's pretty much the same in Melbourne, Brisbane. Adelaide's a little less at 82. But if you extrapolate that out logically and go, okay, so if it's going to do 97% in the next 10 years and then 97% in the 10 years after that, how many 21-year-olds or how many anyones are going to be buying a first home for 4 or 5 million? Well,
you won't.
Yeah.
You won't. And so that's why I say to people, you need to be really careful. As an investor, if you want to pay, $1.5 million for a Sydney property to live in, okay, that's fine. I don't think it's very sensible, to be quite honest, even if renting is really expensive. I don't, again, you have to say, well, is that 1.5 going to turn into 3 million over the next decade? So in other words, in 10 years, we're going to be talking about Sydney average property being 3 million? Pretty unlikely.
Yeah.
Well, you haven't got the wages to support it for a start. So, when you look at what the possibilities are and the probabilities, that's when you look at it and say, well, look, it could double, absolutely, but there's probably a 3% chance or a 5% chance or a 1% chance. But it sure as hell ain't 80, right? Because you'll have everybody living on the streets. Yeah. Except the wealthy will own all the houses, and we'll be back in the 1800s where, you've got master-servant relationships.
Well, could you imagine what the rents would be?
Well, but that's the thing. When you extrapolate it out, you actually say, well, no, I can't imagine what the rents would be. And that's the point. You go, okay, well, something's going to break. If you look at history with all the previous property bubbles, that's exactly what happens, right? If someone could have told the Japanese and went, you guys are going a bit nuts on property and stocks, no, it's all different. We Japanese got a different culture, blah, blah, blah. It's like, boom, no, right? Spain, Ireland, New Zealand, Canada, America, England, everywhere that's had property bubbles have blown up. Now, it might take longer than you think, but they still blow up. And the question is, how quickly can you get out, right? Because like stocks, when Nvidia's, $500 or whatever, you've got to say someone's holding that thing, that asset, right? Like Bitcoin, it's at 73,000. Okay, somebody bought Bitcoin for 73,000 off somebody else who may have bought it for 72, 64, $3, whatever. But what I'm saying is every property is owned by somebody at a price. Mm-hmm. And so when they buy or sell that, they are selling it at a price to somebody else. Not everybody can continue to make money. That's not the way it works, right? Because if you think about it this way, and this is a really good way to think about it, if you said to me, Steve, property's just going to keep going up, I would say to you, all right, Tom, well, I would buy 100 properties. And the reason why is simple. It's just going to keep going up. Now, if it's going to keep going up, well, the price is irrelevant, right? Because it doesn't matter what you buy it. Just buy it, Tom. It's going to go up more and you can sell it more in the future. And then when you sell it, you can just buy it again on Monday because it's going to keep going up. Well, clearly that's ridiculous. And that's the way markets operate, right? They don't go up forever. What you do, and this is one with stocks, right, where you see if you'd have bought stocks in 1926, you'd be a zillionaire. And it's like, yeah, but you'd also be 142 years of age, right?
Yeah.
Right. It's when you buy and when you sell that's important for you, not a time period of 80 years where you go, yeah, but I'm not going to invest for 80 years. Well, that time period's irrelevant. Show me the rolling, like in your case, right? You're what, 30?
Yeah.
Show me the rolling returns over, say, on average, 20, 30 years. That's when you look at it and go, well, the variation is huge, right? If you invested in 82, you make 16% of compound per year to 2000. If you invest in 2000, like we've got the chart there on Friday, the nominal return if you bought at 2000 is, I better put my glasses on, 250 odd %, right? The real return is about 85. Now that includes inflation.
Okay.
Right? So my point being, a lot of the reason why young people like yourselves have had it really hard is because the valuations have been really horrible, right? And the good time to buy property was about 20 years ago, 25 years ago in 2000, right?
In hindsight, it wouldn't have been a bad time to buy 5 years ago either.
Well, yeah, but stretch it out. If you bought 5 years ago, the issue is, okay, you can sell it, but you're going to pay a large amount of costs in stamp duty and taxes and all that sort of stuff.
And then if you're going to buy another one, you're buying into the same market anyway.
Well, yeah. Yes, you know, it's great selling at the top, but it's really stupid if you sell at the top and then you buy at the top again. Well, that's dumb. But the issue with stocks is you can say, I sold in 2000 and I waited, or I bought a property. The problem with property is you can't, in terms of PPOR, right, principal place of residence, you can't sell and then go, okay, I'll just wait. It's like, no, mate, you got to pay rent or you got to live somewhere, right? So it's a different type of investment, and that's what people need to think about, because you get lost thinking all these investments are the same type of thing, right? Bitcoin doesn't have a value, and I'm not criticising. I'm just saying, well, there's nothing to anchor it to.
Yeah, I mean, if you're buying a primary residence, you're investing in a home for your family, right? That's where you want the childhood memories to be and all this other thing. So you're probably not going to be as focused on the valuation. Yeah.
Well, you don't get romantic about buying BHP, right?
Yeah.
But you get romantic about buying the house where you and your wife started your family and your kids grew up and you got scratches on the wall as the kids grew in years, you know, and that sort of stuff. Well, there's clearly a lot of emotional connection with properties and all of that, you know, those stages of your life. Nobody ever says, oh, I remember where I bought BHP, I was in the Bahamas, or, you know, it's just like, who gives a shit, you know. I bought it when it was $10, you know.
I do remember buying the Russian stocks, though.
Yes, so do I.
The rug was very quickly pulled out from under me.
Yes, me too. But that's all part of investing. You know, that's just, not every investment can be a winner. And that's there's those black swan events or whatever happens. And that's why we're sort of talking about it at the moment too, that it's, you know, we're in a sort of transitory period, and that's pretty, you know, it's pretty treacherous.
Absolutely. Look, if we just kind of touch on the outtakes, because I know we're running out of time here. One of the last points that we had to kind of work through is you shared a really interesting graphic. I think, why don't we repost this on the socials for people to see as well? It's just comes down to, obviously, companies are having to be a bit more efficient. People are trying to make more profit with, you know, lower expenditure.
Yep.
And if we look at this profits per employee diagram, energy's the standout performer. Energy and financials. The top one there being ConocoPhillips on $2 million of profits per employee.
Yep.
But if you look at it, it's riddled with energy companies, right? So this kind of reinforces the fact, you know, you look at it, energy's obviously highly profitable, but it's also really cheap, which is another reason why.
Yeah. The reason why I put that in there is because energy is really cheap historically. And the reason why is, if you think, and this just touches on the new normal with demographics, right? If labour costs are going up, what you want to do is say, I want minimum labour input to my process, right? So, for example, I don't know the numbers, but let's say it takes, 10 blokes to run an oil rig, right? And you make $1 million in profit out of the oil rig. It's really good if the labour rates are rising and you say, well, it's not going to cost me much more, and I'm still going to make profit. Where it really hurts is, for example, if you've got, say, a services-based thing, right, where, and I always use this massage therapist idea, because you can't say to a massage therapist, well, look, do 3 people at once, right? It's like, no, you can only do one person for a set. You can't pay attention to 3 people separately.
Yes.
Right? So therefore the productivity is limited.
Well, they have to increase their rates.
Exactly.
Yeah.
And then people say, well, come on, I'm not paying $90 for a massage. That's ridiculous, right? So that reduces the demand. But that's the point of putting this thing in, by saying, if you've got hard assets like steel makers or financials or energy companies where you've got big capital expenditure and not many workers, you stand a better chance if labour rates are rising, right? Because it's not really impacting your bottom line as much. So in other words, your costs might go up 1%, but you've got lots of profit per employee. Okay, well, you'll be fine, right? The problem is where, for example, this is mid-March, but the Fair Work Commission have just made aged care workers' wages go up like 25 to 30%. That is huge, right? Because you can't run aged care homes with robots, right? You need people. And so what's happened now is the operators are going to be saying, well, hang on a second. This is really, because now instead of paying $25 an hour or whatever it is, they're going to be paying 32. Well, that eats into their profit, right? That's the thing. And if that's where you look at it and say, well, hang on, they're not as profitable anymore. I need to revisit that investment.
Yeah.
Right?
Makes total sense. All right, guys, I think that's all we've kind of got time for today. As always, please, if there's anything you'd like to hear us kind of talk about, please write to us.
Drop us a line.
Absolutely. All right. Thanks for listening.
Cheers. See you, folks.
Stay up to date on our socials. Just search for Total Money Management on Instagram and TikTok. For your free investor personality assessment, go to totalmoneymanagement.com.au. And as always, remember, we don't provide financial advice.